The impact of removing zeros from a currency, a game changer for economies? In the world of finance and economics, small changes can have far-reaching consequences. One such change is the idea of removing zeros from a currency's exchange rate. While it may sound like a simple numerical adjustment, this strategy has the potential to reshape the way people perceive money, influence international trade, and even impact entire economies. Imagine a scenario where a single unit of currency, which was previously worth only a fraction of a cent, suddenly appears much stronger simply because 3 zeros have been removed from its exchange rate. This psychological shift can transform consumer confidence, increase spending, and alter trade relationships between nations. However, it is not a foolproof solution, and comes with potential risks that need to be carefully managed. In this article, we will explore the real-world implications of dropping zeros from a currency, its potential benefits, challenges, historical examples, and how it could affect financial markets on a global scale. Understanding the concept of currency revaluation. To fully grasp the impact of removing zeros from a currency, it is essential to understand how exchange rates work. Exchange rates determine how much one currency is worth compared to another. A weak currency often has a high numerical exchange rate, meaning a single unit of foreign currency, like the US dollar, can buy thousands or even millions of local currency units. For example, if $1 is currently worth 1,310 units of a country's currency, it means that 1 unit of that currency is valued at only $0.00076. This makes it seem weak and insignificant compared to stronger global currencies. But what if the country's central bank decides to remove 3 zeros from the exchange rate? Instead of $1 equaling 1,310 units, it would now be worth just 1.31 units, a drastic shift in perception. While the real purchasing power may not change overnight, the psychological effect can be profound. People begin to see their currency as more valuable, which can boost confidence in the economy and increase spending. The psychological impact of a stronger currency. One of the most immediate and significant effects of removing zeros from a currency is the shift in public perception. People often associate large numbers with inflation and devaluation. When prices are expressed in thousands or millions, it creates a sense of economic instability. For example, imagine going to a coffee shop where a cup of coffee costs 3,000 units of the local currency. Now, after dropping 3 zeros, the same coffee costs just 3 units. This simple change makes prices feel more reasonable, even if the actual value remains the same. Consumers feel more comfortable spending, and businesses may see an increase in sales. In countries where hyperinflation has eroded confidence in the currency, this strategy can be a crucial step toward rebuilding trust. When people believe their money holds value, they are more likely to save, invest, and contribute to economic growth. Impact on trade and international markets. A stronger perceived currency can also influence international trade. When a country's currency is seen as more valuable, it can attract foreign investment and make exports more appealing. Consider a country that exports goods priced in its local currency. If the exchange rate makes the currency appear weak, international buyers might hesitate to do business, fearing further devaluation. But when zeros are removed and the currency seems more stable, foreign investors may feel more confident in engaging with that country's economy. Additionally, a stronger currency can lower the cost of importing goods, making foreign products more affordable for local consumers. This can lead to increased competition in domestic markets, which may drive innovation and improve product quality. However, there is a downside. If the currency is perceived as too strong, exports might become more expensive for international buyers, potentially reducing demand for locally produced goods. This is why careful planning and economic strategy are essential when implementing such a change. Challenges and risks of dropping zeros from a currency. While the idea of removing zeros from a currency offers potential benefits, it is not a guaranteed solution to economic issues. Several risks and challenges must be considered. 1. Temporary confusion in the market. When a country revalues its currency, people must quickly adjust to the new system. Businesses need to reprice goods and services. Employees must negotiate salaries based on the new currency values, and financial institutions must update their accounting systems. This transition period can create temporary chaos as consumers and businesses struggle to understand the real value of money. If not handled properly, it could lead to short-term market instability. 2. The risk of inflation. One of the biggest dangers of dropping zeros without proper economic reforms is that it may not address underlying inflation issues. If inflation continues unchecked, prices will rise again, and the cycle of devaluation will repeat itself. For example, if a country removes zeros from its currency but does not implement policies to control inflation, businesses might start increasing prices again to compensate for rising costs. This could ultimately lead to further currency devaluation and economic instability. Third, public skepticism and lack of trust. In countries where previous currency adjustments have failed, people may not trust the government's decision to revalue the currency. If the public believes that dropping zeros is just a cosmetic change with no real impact, they might continue to rely on foreign currencies or alternative assets like gold and cryptocurrencies. This lack of trust can undermine the effectiveness of the currency adjustment and lead to continued economic struggles. Historical examples of currency revaluation. Several countries have attempted to remove zeros from their currencies to stabilize their economies. Some have seen success, while others have faced challenges. 1. Turkey, 2005. In the early 2000s, Turkey faced severe inflation, with its currency reaching extreme devaluation levels. In 2005, the government removed 6 zeros from the Turkish lira, converting 1 million old lira into just 1 new lira. Initially, there was confusion, but over time, the move helped restore confidence in the economy. The revaluation was accompanied by broader economic reforms, which helped Turkey stabilize its currency and attract foreign investment. 2. Zimbabwe, 2009. Zimbabwe experienced one of the worst cases of hyperinflation in history, with its currency becoming virtually worthless. In 2009, the government removed 12 zeros from the Zimbabwean dollar in an attempt to restore stability. However, due to ongoing economic mismanagement and lack of trust in the government, the move failed. The country eventually abandoned its own currency and adopted foreign currencies, like the US dollar, for everyday transactions. 3. Iraq, 2003 to 2010. After the Iraq War, the country faced economic uncertainty, and its currency suffered from instability. To rebuild confidence, Iraq gradually phased out older banknotes and introduced new denominations without excessive zeros. While the process was slow, it helped Iraq stabilize its currency and regain control over its financial system. The transition was accompanied by broader economic reforms, which contributed to overall recovery. Potential impact on global financial markets. The removal of zeros from a currency does not only affect local economies, it can also have implications for global financial markets. First, bond market reactions. Investors who hold government bonds denominated in the affected currency may see changes in their bond values. If the currency gains strength, bondholders could benefit, but if the revaluation leads to economic instability, bond prices could decline. 2. Stock market fluctuations. Companies that rely heavily on exports or imports may experience shifts in their stock prices. A stronger currency can make imports cheaper, but may reduce export competitiveness, leading to stock market volatility. Third, impact on Forex trading. Currency traders Closely monitor exchange rate adjustments, and revaluations can create opportunities for speculation. If traders believe that a currency will gain value after dropping zeros, they may invest heavily, leading to increased demand and price fluctuations. Final thoughts. Is currency revaluation a viable solution? Removing zeros from a currency is a powerful tool that can reshape economic perception, boost confidence, and attract foreign investment. However, it is not a standalone solution. For this strategy to work, governments must address underlying economic issues such as inflation, fiscal policy, and public trust. Without proper planning, the benefits of dropping zeros could be short-lived, and the economy might fall back into instability. As we have seen from historical examples, currency revaluation can work when paired with broader economic reforms. The key lies in careful execution, clear communication, and a long-term vision for financial stability. What do you think? Could removing zeros from a currency be a viable strategy for struggling economies, or is it just a temporary fix? Let's discuss.